How about now?
There I am.
There you go. Now you're
Okay.
unmuted, Ben.
Thank you,
Hiya, Ben.
Steve. Hey, Dale, how you doing?
Good, buddy. Welcome back. So, glad that your presentation stayed whole.
I had
And
to rebuild it, but it's nice.
oh
It's good.
wow. Okay,
It got
so
it got better. How about that?
I believe that. So I'm just going to let you go and talk about what you're seeing going into your end. I noticed one of the tweets is you think that a lot of the weak gold longs were finally shaken out and that the lows are in.
Yeah, and it's kind of going to be the theme of the presentation, which is, the markets, and Steve referred to this. Steve is great. The last few times I've come on, he's sort of touched on items I'm going to talk about and previewed the subject. So he's a perfect setup, man.
Yeah.
But one of the things we're going to talk about is that, the markets always set up the crowd to get hurt. The crowd is right in the middle of a move. The crowd is wrong at the extremes. And so you can't just be a wild, sort of reckless contrarian, which I was early in my career, and I paid the price and I paid my tuition to the market gods and learned it only works. Being a contrarian only works at either end of a move, right? Either at the beginning or when the move is near the end. It doesn't work in the middle, and that's when you get run over. So I'm seeing that in a lot of markets, important markets, stocks, bonds, currencies, the metals, and we'll go over the charts and we'll look at, some of the issues in addition to looking at, some of the situations they're in addition to, a quick review of the cycles and what's going on with the cycles, because we want to always be aware of the background weather.
Okay.
First, I'm a big proponent of personal responsibility and accountability. It's part of the reason why I post a lot of stuff on Twitter is I want to be accountable, right? I want to have to answer to what I think, what I believe, and what I'm saying. And so in January, when I was on your show and we were talking about sort of major trends and things to look for in 2020, these are the three that I highlighted: volatility, commodities, and inflation/stagflation. Two of the three have hit so far, and I think hit pretty well. We've seen unprecedented volatility early in the year. We may get a bout of it here in December again. Commodities have come to life, and I think that's a trend where we're in, the first couple innings of that game. If you're looking at a baseball analogy, there's much more to go, and we'll look at the charts and see that. The inflation stagflation one is still sort of a question mark. I firmly believe that inflation is here, and anybody who goes to the grocery store feels it and sees it. It's going to work its way through the rest of the economy, but I think this stagflation inflation theme is going to hit pretty big in the coming year. We talked a few like in June, I think in the June talk, we discussed this epic cycle that is sort of the background weather that we're operating in. This is a huge cycle. I mean, it goes back over 400 years. And it's the tenets of this cycle and the things to understand about this cycle. The cycle is all about development of these large centralized institutions and organizations that we use to govern society, to get things done, to produce the materials and the products needed. It's all about creating big organizations and big structures that we've relied on for years and years and years. What's currently happening is we're in a phase where there's a loss of faith and trust in these sorts of institutions, and we're seeing the fragmentation of them right now. What we're going to experience and continue to experience over the next 5-6 years as we end this part of this cycle is a transition into more decentralized systems and individual responsibilities. So we're not going to be relying on these large, massive organizations anymore. We're going to be more self-reliant and more sort of tribal in a smaller way. What I've put on this slide is examples that we see of failing, and I have that in quotes because they're not, they're not out of business or not completely defunct, but they're beginning to fail. And the most important thing is the confidence that people have in them is failing. We've seen it you can go through the list and you can see examples of it. The most recent ones that I have question marks next to, when I brought this up in June, we talked about the Federal Reserve, how everybody said, the Fed is God. Whatever the Fed does, you got to follow the Fed. You can't fight the Fed. It's the Fed. It's the Fed. It's the Fed.
They still believe that, Ben.
They still believe it, and it's still true to a certain extent. But what we're starting to see in the articles, you're starting to see stories, you're starting to see questions, you're starting to see at the press conferences, you're starting to see people questioning, what can they do now? What power do they have left? Okay. And of course, Powell is, insisting, we have plenty of tools at our disposal. There's plenty of things that we can do. He's saying that while talking out of one side of his mouth, while the other side of his mouth, he's saying, Congress has to pass fiscal stimulus. We must have fiscal stimulus. Well, I think he's beginning to, lose his poker face and showing that maybe they are at the end of their rope in terms of what they can do.
Mm-hmm. Yeah, the population will lose faith when there's a decline in the market that the Fed can't stop.
Very true. That's going to be the ultimate end of the Fed. The last one I have is disturbing for many people, but it's something we have to look at. Is this experience that we've just gone through, is this the death blow of people's faith in elections and faith in representative democracy? I certainly hope not, but this is, one of the, without making any political statements, because I don't want to get political, whatever happens, whatever the end result of this election is, half the country's going to believe it was stolen from them.
Yeah.
And that's a tough situation set up for the markets, set up for the next administration, a tough setup economically moving forward. So we have to keep those things in mind. The reason I'm bringing it up again is not about politics. It's about in conjunction with this major 400-year cycle that we're looking at. It fits perfectly. And when you know that we're in this kind of cycle, you filter sort of the news and you filter events looking to see, that's why this is happening. I see it fits with what's going on.
Yeah, this was much worse than Nixon to bring about people's distrust of the system.
No question. No question.
By, in magnitude, kind of like, maybe feeling a 2.0 quake and then having a 9.0 is right. What we've just gone through.
Yep. And I think,
thank you, President Trump.
I think it has everything.
I'm not going to get political. Thank you. Thank you very much, President Trump.
And I think the reason it's more intense and more damaging is where we are in the cycle, right? That Nixon was 40 years ago, 50 years ago.
Yeah.
Now we're near the end. So that's why it happens. Another cycle that we've talked about on your show for a couple of years now is this connection to the 70s that we're currently experiencing. All the ones with check marks we've already discussed, and they've come up and they've sort of been proven out. The ones below are ones that are yet to play out, but I think they're where we can see the path to them coming true. The New York City fiscal crisis in the late 70s. With the exodus of people out of the city, especially people who are supporting the tax base, no doubt New York City is going to see a financial crisis in the next year or so. The stagflation we've talked about. The latest one I put up, which I thought was really interesting, and the connection dawned on me when I saw what was happening with Nixon and then Carter. Joe Biden is the cycle version, the 70s cycle version of Jimmy Carter. He's a Democrat who's coming in after a president who created issues, was highly unpopular. And I hope it's not going to work out the same economically, but the cycle is set up that way. That
Different party though.
Jimmy Carter was a Democrat.
Oh, that's right. Yeah, that's what.
Jimmy was a
That's right.
Democrat. So it's
Yeah, it
rhyming, right?
is. Why
It
it
may,
is rhyming.
yeah, it may not play out exactly the same, but the setup is there, and I think it's something to watch and to
Oh
see how it
boy,
goes.
you're bumming me out.
Well, it's being aware means we can be prepared, right? We can get
Yeah,
ourselves positioned to where we don't get hurt and we can possibly benefit from it. And that's what I'm
yeah.
trying to look at.
Okay.
This is the cycle. This is the S&P from 71 to 75. I'm showing where we are in the cycle, which is, you can see by the arrow where we are. The X here, it's a little faded, but it's a little too dark. But this is where the analog actually stopped following. We were following it perfectly up until then, currently, and we stopped
Yeah.
following there. The reason I show this is just to let people know and let you all know that the cycle's still running. Does that mean we're going to have a collapse in the markets? Absolutely not. Does that mean it's possible? Yeah. And the next section of this presentation that we're going to talk about, I think, is really important. And Steve referred to it today in your all's part of the show about risk versus reward. I think we are at a very important point in many markets where risk versus reward needs to be carefully examined and calculated. And the thing that struck me and why I wanted this to be the main topic of the presentation is it all goes back to what's the role of us as a trader? What are we supposed to do as traders? A lot of people, especially new people, myself included, when I started, is I thought you had to be, the person who could predict the future, right? Predict the markets, where's it going, and get yourself positioned. And, it was all about the ego and my ego at that time. I don't think I've come around to the view that sets you up for failure. It sets you up to not be able to change your mind. It sets you up to not be able to listen to the markets, and essentially sets you up for failure as a trader. What I've come around to and believe that is a healthier way, both psychologically and financially, to trade is look for markets where there's a mispricing of risk, where things aren't being factored in, where your risk reward is in your favor. Where you can create probabilities where you don't have to be right 100% of the time to make money. You only have to be right a fraction of the time if the risk reward is in your favor and you let profits run. So what we're going to do is we're going to look at some examples of markets where I think there's a mispricing of risk. We're going to look at the most crowded trades. And right now, the most crowded trades are long stocks, short the dollar, short bonds, and it was long gold. And I'll show you, because gold is a perfect example what I think can happen in those other three markets and many markets that are sort of where the risk reward ratio is out of balance.
Okay.
The key thing to understand about this is long term, I believe stocks are going much higher. I believe the dollar's going much lower, and I believe bonds are going much lower. But you have to look at trading is about timing. And right now, those markets are set up to hurt a lot of people who are in a crowded trade. And that's what I want to go over in the charts and look at some of the geometry and some of the sort of the background. In the intro, I put a slide in there, and I talk about this on Twitter a lot. In the markets, you have to think like a criminal, right? And this because the things are counterintuitive, right? You get a report saying, oh, the economy shrank this past quarter and the market skyrockets. And you say, well, how does that happen? How can that happen? Well, because everybody most likely was already in position expecting the bad news. The bad news comes out, the institutions and the big money that can move the market use that as the opportunity to jam it the other way. So you got to think like a criminal and think, how are these guys going to hurt the most people, and make sure that you're not exposed to that side of the trade. First thing I want to talk about is gold, because gold is an example where we had very strong positioning on one side of the market, and the market did the opposite. real rates in gold. This is from the 70s, and I put this chart in to show that when this setups occurred, you have a powerful move in gold. So the fundamentals for gold currently are in line with the fundamentals of gold in the 1970s. Gold versus the money supply. Again, look back at the 70s. We're heading this way, right? Money supply is up tremendously. The gold price needs to rise as well. So this is the setup. This is the fundamental setup. The problem with gold was we were so heavily weighted in precious metals, and sentiment was so strongly bullish, that it created a negative, sort of a negative setup, a setup for failure. And you saw what happened when sentiment's high and the gold price is high. Gold came off. A couple days ago, we had a nice reversal in gold. I posted something about that, about adding to positions, because a lot of that sentiment has been washed out, and the risk reward obviously is much better at, gold at 1750, 1800 than it was at 2100. And look at how the flows have changed on gold recently. Strong money going in into the highs. We get this correction and the money's coming out of gold.
Yeah,
Now,
I heard that was one of the biggest outflows in I don't know how many years.
Well, if you look at this chart, it's at least 15 years.
Yeah. Okay.
So
that wasn't far away from the reaction we got.
No, and this is the idea of right. If the boat's too crowded on one side, you got to be careful, because the chances are they're going to tip it, and they tipped it. They took it from 2100 down to 1750. But the fundamentals for gold look good long term, very good. Let's look at the geometry. Let's look at the technicals.
And I will acknowledge that when I first started interviewing Ben, there was a weekly breakout that he said he was going to get long on. I think it was 1360 or 80.
Yep.
And it never looked back.
Yeah, it was a good level and a good breakout on the geometry.
Yeah.
So here you see the daily gold with my geometry on it. I show the ABC down. We could possibly make a move down to this level. If we fail and roll over and take out this low, there's very strong support here in this 1750 area. Let me see, where's the exact number there? Yeah, right around 1759. Maybe they overthrow, really push it, take it down, complete the ABC. But I'm very bullish on gold now. We either have seen a low or we're close to the low. I added to positions here because of the support we got on the geometry, the washed out all the late longs. Everybody who got long up here is gone. They're done.
Okay, so if we have one more jiggle to the downside, do you get out of the way and then see what happens if we take out this low that we
I'm trying to trade this for the big move, which I think is we're going to go to new highs here. So I bought some more at the lows here. I'm staying with it, and I'll add to the positions if we come into those support areas that I see, that you see on the chart.
Okay, so it's kind of a scale then.
Yep. Yeah.
Okay.
Here's the monthly on gold. Again, it's another look of how we accelerated up on the circle. We got stopped by the geometry here. We found support on the geometry here. Another reason why this is a good area to add. And this is monthly. So this is not a 5-minute chart or anything. This is big picture. I mean, gold can, I think if it does what we think it's going to do based on the pattern, you're looking in upper 2s, 3,000, potentially 4,000 possibly.
Okay.
So big move coming here. Silver's one I like to show because earlier in the year when I was showing these charts, if you look at the chart of silver, remember this chart in the formation, almost all of the commodities that I follow have a similar pattern where we've got multi-year base, 5, 6, 7, sometimes 10-year base, and then they're beginning to break out. You saw the breakout in silver, got stopped by the geometry here at the high. Now we pull back into the geometric support. So anywhere in this 21, 22 area, silver's a good buy. Again, looking for new highs, certainly going to eclipse this high at some point in this cycle if the commodities do what we think they're going to do. So silver, very bullish. Okay, Dale, here's your morning quiz. I know it's Friday and everybody's a little burnt out and tired. What do you think this chart shows?
The the megaphone and the S&Ps?
One is the S&P. What's the purple?
The purple is money supply.
Close. Fed balance sheet.
Okay.
So basically right now, since the COVID hit, the trade in the S&P is a trade on the Fed balance sheet. As long as the balance sheet is rising, the market will rise. When the balance sheet flattens out, we get sort of choppiness or corrections. So you're betting on the Fed when you're betting on the S&P right now, and it's a good bet. It's been working. It keeps working until it doesn't. But let's again look at the risk reward. Financial conditions right now are about as good as they get. We're at below the conditions. Any of the financial conditions are as good as they've gotten since the mid 90s. You can see what happens as we have these perfect conditions. A lot of times you get a correction. Doesn't mean we're absolutely going to get a correction. It just means, again, the odds favor that to happen. Percent of stocks above their 200-day moving average. Again, just another marker saying where are we in this move? Where are we? Is it late in the game? Is it early in the game? This is telling you we're late in the game when you're looking at the S&P. Sentiment, short interest, new lows in short interest. Short interest is actually well below the levels it was going into the last financial crisis. There is no interest in shorting. Does it mean the market's going to go down right away? No. Does it mean the risk of the market going down is a lot higher? Yes. Fear and greed index. This is the CNN index. I just put it in here it's a shorter term thing, but again, it shows you where are we in the cycle. The whole move up, we were in this red zone from the lows in March through the summer. We were in this red zone. Now again, the risk reward is not favorable for longs. Investor intelligence bulls. Look where we were in the lows. Look where we were all the way up over the summer. Look where we are now. Again, it's a time to look at it and say, okay, if I've got long positions, what's my exit strategy? How much am I willing to risk? How much am I going to give back? What am I going to do? Here's the percent looking for corrections, again, below the levels of the 2008, 2009 crisis. So sentiment's pretty bullish. Call options.
Wow.
Astounding, huh?
Yeah.
That was the day before Thanksgiving. Record. Yeah. Beyond anything we've seen since the go-go 90s into the dot-com bubble. But it's been a winner. You got to say the people that have been playing it have been winning. Here's a 5-day moving average of the put-call ratio, CBOE put-call ratio. Again, does it mean the market's going to crash tomorrow? Absolutely not. Does it mean your risk reward is not tilted in your favor if you're initiating longs today? Yeah, that's what it's telling you. Or you better keep it on a short leash. Day trade, couple day trade, keep it tight if you're going to be long. And I've been trading the long side as well on the ES, but on a daily basis, because you got to go with where the action is and where the flow is. Insider transactions, again, another record. They're selling. Yeah. Are they great at timing? No, but they just tell you where they think value is.
Okay.
Here's an interesting chart too. This is S&P in dollars, S&P in euros. So this gets to the point of if the dollar stops being weak, the market's going to stop going up. So if you're betting on long equities, you're betting on a weak dollar right now. Yeah. Because in euro terms, we didn't even take out the previous high and the January, February highs of earlier this year. We're still below those.
Yeah, interesting.
Mm-hmm. So now let's get to the charts. Let's look at the chart evidence. What are the charts telling us? Well, the chart on a monthly basis is bullish. We closed over this important geometric support resistance, which we were having a lot of trouble with earlier in the year. It's basically the 3370, 3380 area. We closed above that. So right now, shorter term, it's bullish. This line up here is around 3706. I think that's a reasonable target. We've got geometry there that could probably stop this. If things turn down, the geometry here and geometry here and geometry here are possible landing points. 3030 is an area where we could hit. If things get super ugly for whatever reason, the bottom of this megaphone is around 2020, which would be new lows.
Okay.
Here's one a little shorter term on the daily. I know Dale likes these timing charts. These are simply calendar days from different highs and lows. And they're important. They're sort of Ganniversaries, as they're called. We're coming up on a bunch of them. We're actually in areas where they're going to be. December 2nd was one. December 10th is another one. December 16th, December 23rd. So there's clusters of them coming in off of different highs and lows, off of this, off of the move from the low in March. Mm-hmm. We also have important timing, which is 360 days, the anniversary of that low. So it's coming up in March. So what am I saying here is in March, we're either going to have a very, very important high or a very important low. Do we run from here to March? Well, wouldn't that be the repeat of 99? Remember 99? How
yeah. Mm-hmm.
Year end, we ran up into from 99 into 2000.
Yeah, it was March. Yeah.
So it's possible we go up there. It's also possible we could top here and head down. That's where we have to rely on the technicals and see when the charts tell us it's time to go. This is an interesting chart because I've been looking at the VIX, seeing what clues we could get from that. And this is VIX futures. And what I've noticed that the important line is 24 in the VIX futures, and that corresponds with this geometric line here. Every time we've tried to get above 24 and have been able to hold under it, the market's in a favorable position to rally. And whenever we get stuck above it, the market's vulnerable to big moves to the downside. Right now, we're dancing around the line. So this is very important to watch because it'll be a clue. If we can get under this thing and stay below it, then the melt up is going to really be on. If we can't escape this 24 area on the VIX futures and we can stay above it, you got to keep an eye on the exit and 1 foot out the door because that black swan event is much higher probability when the VIX is above that. The futures are above 24. The dollar. We talked about the dollar, how it's all about the dollar. My concern with everybody betting on long stocks and short dollar is the positioning in the US dollar right now. Everybody and their dog is short the dollar. And the market generally likes to punish one-sided positioning. So I don't know what's going to cause it. I don't know how it's going to happen. We'll look at a few charts and see, well, where we can get clues as to when it might be happening. But there's going to be some sort of dollar squeeze to hurt all of these people before the actual big move happens in the dollar. And if you ever day trade or watch a super short-term chart, you can see them do it on a much lower time frame. Right before a big move happens, they run it the opposite way, clean out some stops, and then the big move happens in the opposite direction. I think that type of thing's coming in the dollar. Again, I don't know what the catalyst is going to be. I don't know the excuse or why or when, but it's coming. Probabilities favor it anyway. Here's again a look at the dollar and asset managers' positionings in the dollar in terms of short. Look at how short this market is.
Yeah.
It's pretty heavy on one side of the boat.
Yeah. Yeah.
So let's look at the dollar. Let's look at the Dixie first. Let's look at this chart. We broke an important trend line. A lot of people jumped on that, and we saw some acceleration down. What I think is going to happen in terms of probabilities is we're going to find a low in here. There's going to be an excuse to squeeze the shorts, and they may pop this thing up to the 94, 95 area.
Okay.
And that's where the geometric support and resistance, if they can continue to break it, and if they just keep pushing, 87.70 is the support down here. That's the next support on the monthly.
Okay.
And that's the highs from 08, 09
Right.
area. So that's what we would be looking at in the dollar. Here's the euro. Euro broke out of this trend line. It's still dancing. It was dancing with this for 4 months. It was dancing with this important geometric support resistance. We're currently above it. The area where it's important is this 119.73 to 119.55. So if we pull back and can stay on top of that area, we got room to run much, much higher in the euro. If we get stuck back below it, you'll see a pretty strong dollar rally, and the euro will go down pretty hard. Aussie. Aussie's in a little different position. We're still below a trend line, a major long-term trend line, although we are above geometric support resistance. The key number there is the 72.70, 72.80 area. As long as we're above that, it's bullish on the Aussie. If they get back below that, that will be your dollar squeeze. So the dollar holds the key to the stock market and everything else. Watch the dollar, know where the dollar's going, know what the dollar's doing. Let's go to rates. I saw this survey and I thought this was really interesting. Only 8% of market participants in the fixed income survey that JP Morgan did are looking for lower 10-year yields in the next year. 8%. That means 92% are looking for higher rates. That's pretty one-sided.
Yeah.
How about some risk reward? Yield curve expectations, all-time highs. Everybody's looking for a steepening curve, looking for higher rates.
Yeah.
The market generally likes to punish that. Let's look at the bonds. So here's the 10-year, big move up. The circle was able to catch the slope and the geometry there. Right now, we've just basically been going sideways. No big moves either way, I think, in the 10-year, because this is where the Fed is acting. But I don't see a strong move lower right now in the 10-year. Could we see it go up and touch the old highs? I think so. In conjunction with dollar strengthening, I think we could see that, and market weakness. The 30 is where I'm actually in play. I've got some long-term options, call options on the 30-year, because we came right down, tapped geometric support resistance here, important support. Rates have been moving up, but I think the setup is there again based on sentiment and the technicals here. Yeah. You got one-sided settlement, you're at support, you buy it. And that's what I did. And let's see how it plays out. If it doesn't work out, I know where I got to cut. We break this line, I'm out. But I think we're looking for lower yields, higher prices in the 30-year treasury.
Nice look.
Commodities. We talked about commodities in the beginning of the year. How's the risk reward set up for commodities? I think it looks the opposite of the stock market right now. Right? Yeah. Look at the commodities to GDP ratio. Yeah. Look what happened in the 70s. Could we have a repeat of that? Sure. Are the cycles set up for that? Yes. What if we only get a fraction of that? Could be a hell of a move. So risk reward in commodities looks good. Some people say, oh, the commodities have had a big move. We missed the bottom. Well, look at where we are. Look at the move up so far. It's just taking us back to levels in 2000, the lows.
Embryonic.
Yeah, we're in the beginning of this commodity game. So the risk reward, I think, set up in this market is much more favorable than the other markets we've reviewed. S&P Agricultural Commodity Index. Yeah, it's a nice move. This is the first inning, man. This is the beginning. Do I think we're set up for a pullback now? Yes, and we'll look at some of the charts and talk about that. But this is early in the game if you're looking big picture. This is just corn, wheat, and soybeans. Nice move, right? And you'll see it on the charts. Really, really good bases, breaking out of bases. Here's beans, 6-year base on the monthly. Broke through all the downtrend lines. Strong, powerful move up. Very good geometry at the high, not on this monthly, but just in the counts off the lows. So a pullback here or a sideways action to burn off some time, completely expected. I'll be adding to positions and reinitiating positions that I sold into support here. This is a market that is bullish.
Okay.
And your beans in the teens, I think, is coming. Wheat, another market, very similar. Almost a 10-year basing pattern with a breakout, consolidating now, could see a pullback or just mark time, another bullish market. And remember that silver chart that we saw?
Yeah, same
in
base.
the beginning? Same base, breakout. Same base, breakout. Corn, a little behind the other two, same pattern. Base beginning to break out. Notice how the geometry caught this high too, in addition to the downtrend line. You know, that's not the place to buy. Wait for a little pullback and then buy.
Right.
Coffee, base, breakout. Look at the geometry here. A big battle in coffee right here. Once this is done, should be up and out once that's resolved. But the key again is you're buying off of a big base, as it begins to break out. You're not buying up here.
How much more do you have to go, bro?
Got a couple more.
All right.
I'll go fast. Cocoa, same thing. Sugar, same thing. Cotton, same thing. Crude oil. Crude oil is a little different chart, but it does look bullish. Finding support in the right spots, staying on top of it, moving higher. Support on geometry, up. Support on geometry, moving up again. Crude looks good. Copper. Steve was talking about copper. Beautiful chart. Nice base, breakout, buy it on pullbacks. Last thing, one of the things we talked about was inflation and stagflation. Inflation is here, stagflation is coming. Best strategy is to buy real assets. There's your CPI for the 70s. That's going to be repeating. How real assets have done in the 70s. Best performing assets were real assets. Last thing, John Malone, very smart money, chairman of Liberty Media, recently announced moving money into hard assets like housing and commodities, buying hard assets. I want to invest or diversify into hard assets. Commodities were cheap. Smart money knows it. They're doing it. We should too.
Nice presentation.
That's it.
Then that's where you find Ben at Ben Maldonado. Someone said best presentation we've ever had here on F.A.C.E.
Well, that's saying something.
That is, because there've been a lot of them. But people you are a regular now, Ben. People look forward to you. So thank you, buddy.
I appreciate you, Dale, and I really enjoy the time I spend with you, and I love sharing the information, and hopefully it helps people.
Justin saying, well done, Ben. Amazing, Ben, from Hugo. Galaxy Note says, yes. Great presentation, Ben and Dale. Okay, so thank you, my trading warrior brother. May all your forecasts manifest and you be there to maximize profits.
So be it.
Amen.
Amen.
All right, buddy.
Have a great holiday, Dale.
You too, buddy. I'll be in touch with you. Thank you very much, Ben.
All right, take care.
All right, and we'll see everyone next week. Remember, don't just count your commodities, count your blessings. And I'll see everyone Monday. Adios.